It's Friday, July 12th, 2024, episode 243. I'm Patrick Ceresna. Kevin is taking a much-needed vacation and will be back next episode. This week, I welcome Pinecone Macro's Chase Taylor as we pull out some crayons and take a deep dive into talking charts. Quick disclaimer, nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much market huddle may include natural gas nausea, Fibonacci fibits, and lumber future lacerations. All right, let's get Chase on the call. I have the great pleasure of welcoming back to the show from Bulwark Capital and Pinecone Macro, none other than Chase Taylor, my favorite guy to shoot the shit about charts. So how you doing, bud?
Doing great, man. How are you?
I'm great. I'm looking forward to chatting with you. I can't think of a more interesting time to bring a fellow chartist on to just talk about some of the crazy things going on in this market. And we're recording this a few hours after the release of the CPI, and the inflation numbers came in a little bit lighter than expected, but the market responses were quite pronounced. And so I figured we would just start off right at the top with the S&P 500 and just highlight, first of all, what's been happening up until now, and then these reactions to the inflation numbers. And so clearly we have an S&P that's been ripping higher, driven almost solely by the Mag 7s. And we had things like the equal weight S&P incredibly flat, the Russell incredibly flat. And suddenly we have these inflation number come out. The first response was the market rallied. And then now we find ourselves a couple of hours later down 50 points. But it's not the fact that we're down 50 points on the S&P, but the equal weight index on the S&P is up 1%, and the Russell is up 3% on a huge breakout. So some sort of big sector rotation seems to have been triggered by this. What's your first impression of what's going on?
Yeah, to me, the biggest thing here is it was driven by IWM, like Russell 2000 ripping, which if you think about all of the companies that a lot of those companies aren't profitable and a lot of them have floating rate debt. So having, these rate cuts kind of get locked in all of a sudden with the super low inflation print and basically being flat for 2 months running now, that allows a lot of like really crappy Russell 2000 floating rate companies to like get tremendous relief. So that stuff rallied. And then typically you see this like factor thing where if the Qs are up big, then IWM will not be. And then if the IWM is up big, the Qs will not be. So I think it's just like this crazy factor stuff where if small caps rip, almost by law, the Qs have to go down.
Yeah, it's insane.
I think that's driven everything.
This is that Russell over NASDAQ chart, and you can see exactly that. It's been the NASDAQ ripping nonstop as the Russell's been hugely in a downtrend relative to it, and suddenly this big reversal day today, having that have a big turn. But it's interesting because the equal weight S&P had a pretty distinct breakout higher as well with that while it's the NASDAQ that's turned. Now, I wanted to particularly touch on these Mag 7s. Like, how do you size up the trends that we've been seeing in all of these? And do you think that this could have marked a key turning point in these?
Yeah, I mean, it's possible. The Mag 7 is down as we record here early in the session, over 3.5%, while equal weight's up 1%.
Yeah,
and that's something I've been like following really close lately. Is just watching Mag 7 versus equal weight, and it's been pretty stunning. Like just last week, which was 3.5 trading sessions, you had basically almost 9% outperformance from Mag 7 versus equal weight, and then just today it's basically 5% back the other way. The question is, how durable will it be? And I think the only way the relative move there is durable is if you're able to actually get these rate cuts and you get more of them than expected. As far as Mag 7 like outright, to me that's mostly a passive story. Obviously their earnings have been good and the AI hype is like another layer of the layer cake there, but at the end of the day, to me, as long as 401k inflows are there, so will they be. They'll just keep getting bigger versus everything else. I think that has to go the other way for meaningful move down in most of those companies, unless you would just get the AI, falling on its face a couple quarters out or something, where everyone decides that wasn't worth the money and kind of moves on, and people have to look at it and be like, well, that was weird. They wasted $1 trillion. But other than that, I think it keeps going. And today is probably just a one day thing because IWM just decided to go through the roof.
Now, the way I kind of size it up is that almost every parabolic move will have some sort of mean reversion or retracement, and that may come across as a bit of a sector rotation, and clearly moving money from one overbought space to somewhere where you can almost hide your in some sort of an equity that does well when it's correcting. Do you think that this could materialize that, where we basically have just a summer correction in the Nasdaq and the S&P 500, and people are hiding in some of the other sectors?
I honestly doubt it. Just because I mean, I think you could see that on a limited scale, like you said. I mean, this on a relative basis, it was turning into a pretty intense parabola. So having it come back to earth makes perfect sense. But it's hard for me to see a particularly durable trend, just because if you think about IWM, it gets no flows from 401ks and stuff like that. So it relies on like real people that are doing like real work buying it. Like, because other than that, no one cares about it.
Right.
So you can have these one day events, and like, don't get me wrong, if the Fed starts slashing rates, like there's enough people to probably look at that and go like, wait a second, this company had negative earnings, but now all of a sudden their floating rate debt has allowed them to have like pretty decent earnings. Like that, a lot of stuff would re-rate, but knowing that one of those two is going to go up no matter what, just because of the math of more money going in than out, versus one that requires human beings to stare at it and like it enough to buy it. Like clearly the tie goes to the the Qs or the S&P Mag 7, however you want to look at it, basically all the same these days. So unless you get rate cuts like really hitting hard and helping those floating rate companies, it's difficult for me to see this being particularly durable. I could see the 20-30% unwind of the crazy move higher, something like that, no doubt. But for now, not durable.
Okay, so the interesting thing that I was observing here was just the global marketplace, and you look at all the other developed markets around the world, and a lot of them have been stuck in the mud, like the Euro stock. But the one that really has taken off has been the Nikkei. And the Nikkei went through this kind of 3-4 month sideways correction and really blasted off. Have you been tracking this, and what's your thoughts here on the Nikkei as an investment?
Yeah, I've done well trading the Nikkei the last couple of years, but I think Japan's gotten a little too popular for me as an investment. And my problem with it is the Nikkei, the topics, however you want to look at it, like it's basically been just doing the inverse of the currency. So like just the fact that the yen has gotten creamed has just made the stocks go up. So my concern is if that were to unwind, and having U.S. inflation go away is a great way to have it unwind and have the yen go back up. I think that should eventually be good for Japanese equities, because I think they'll get the capital flow is kind of reversing and coming home, and I would assume people would want to buy the equities. But I think before you get to that realization and those flows, you will have to go through a painful kind of unwind of the great market we've seen in Japan for the last couple of years, just based on the currency going back up, assuming that's going to happen. Now, if your view is like, no way, like the yen's going to keep weakening dramatically, then I think it's crazy not to buy Japanese equities.
Well, I mean, we have to then talk about these currencies because there was a huge move in the US dollar yen. But let's first just touch on a high level by looking at the dollar index. And the dollar index itself has been in a big muddle, failing to follow through to make higher highs, not really making lower lows. It's been a multi-month trade range, but really it's even beyond that. If you put on a weekly chart and zoom out, really we've been in almost a 18-month trade range that is encompassed by the 100 to like 106 range. And the bigger question is, currencies, especially like if you look at that dollar back over from 2020 to 2023, there's some extraordinary volatility that the currencies are capable of. What in the bigger picture, do you think volatility trends will come? Currency trends will come back into play at some point here?
Yeah, I do, and I think it could be very spicy in the next 2 or 3 years. I think the thing that would make it most spicy, obviously, is going to be politics, whether that's in the U.S., Europe, or both. I mean, you have at this point, you could call it a likely incoming administration who has, Robert Lighthizer will probably have an important role in the White House, and he is a very outspoken advocate for weakening the dollar. And at the same time, you have, the French election, and that it feels a little bit like almost on purpose trying to like plant the seeds of chaos in order to punish, the far right, or in this case, as it turns out, the far left. Basically punish the voters for going outside of the 3x5 card of allowable politicians. And if that were to happen, and kind of Russell Napier's view is like, you might have something like that happen, and then the ECB won't come to the rescue. Like, say it's whether it's France or Italy or whoever decides, you know what, like I'm just going to run a huge deficit. I don't care what you think. And their yield spreads blow out. Like in the last 20 years, we've, when that's happened, the ECB just steps in and buys it, and then everything's fine. If he's kind of right that maybe they'll just step aside and just kind of watch it burn, and again, to part of this, like, let's punish the voters for thinking they can, elect the fringes on either side. Like that's the kind of stuff where you could have like massive fireworks in FX again. Not to mention you already have, China kind of messing with global liquidity to try and keep a lid on the devaluation of the yuan. So like there's a lot of different angles of where I think we could see pretty significant fireworks in the currency sphere.
Yeah, it's been truly a mixed bag between, like, the euro has generally been on the weaker end, at least trade range bound. But there's been almost no trend in the US CAD. The Aussie's been strong. Like even the pound sterling has broken out of its year to date range and is heading higher. But so you have a lot of these cross currents where there isn't a lot of clarity by all of the cross currencies sort of aligning, and it's kind of like the U.S. dollar up and them all down. It's been just kind of almost like a trader's market where you have to pick the right currency pairing. But the one that had the most interesting reaction was the 2% move, 300 pips on the U.S. dollar yen in reaction to that inflation number. And obviously, the U.S. dollar strength and yen weakness has been one of the big stories of the year, and it just seems like this is a move that's a deja vu of that move that we saw at the 1st of May when the Bank of Japan, at least supposedly, was trying to intervene at the 160 level. Do you think that this is a meaningful turn? Is this something that investors can't ignore, or do you think that this could just be a quick buy on dip for a continuation, at least on the short term, obviously?
So I think it really comes down to your U.S. macro view, and I think that is the most important fundamental for the yen. It's just what's going on in the U.S. If the U.S. is able to do some like significant rate cuts in the next couple of years, then the yen will be fine, because they can't do enough with their policy to kind of close the gap on the significant spread between our monetary policy and theirs. So they really require us to do all the work. So if you think the Fed's going to be able to do a bunch of rate cuts, like especially if you think you're going to have a recession, then buying the yen makes a lot of sense. And I would argue kind of avoiding the equities, at least short term, makes sense. But there's been so many times where I thought like this might be the spot where the yen can start, actually picking up, and then next thing you know, it's right back up. But that probably just reflects the U.S. cycle, like where every time you smell a little weakness in the U.S., next thing you know, like you're growing at 4% and you still can't get inflation, meaningfully in the tooth. So I'll honestly say on this one, I don't know. It's like the charts that make the most sense to me. Like you already showed the pound, and you mentioned the Aussie. So like Aussie versus the dollar or the Kiwi, all of a sudden look really solid to me. And then maybe the ultimate currency of gold, but.
Yeah, well, we'll talk about gold in a second, but we have let's touch on Bitcoin first. Bitcoin obviously had just a spectacular run in 2023, going into the first quarter of this year, and a run basically from 25,000 to like 75,000. I'm rounding, obviously, but since then it's been very toppy and very heavy, and we broke to lower lows. Distribution, almost every rally seems to be getting hit. What's your take? Do you think that the Bitcoin, at least cyclically, that this leg of the up move is over, and you think that there's a correction here, or you think that this is a short-term buy and dip?
I'm going to go short-term buy and dip. I think we just had the correction largely. That kind of like 58,200 level. Like we've tested that 6 days in a row from the below, the bottom side.
Yeah.
So I think we're kind of probing a break higher. Like we keep getting knocked down by the 200-day right there because it's just under 59. Like I mentioned earlier, like global liquidity has just kind of been sluggish. We had tax payments in the U.S., stuff like that late spring, but now like China is just kind of sitting on global liquidity because they're afraid to do any stimulus, because if they do, like their currency's gone. But what we just had today probably allows for China to do a little more stimulus because the dollar's falling, and that obviously would be great for global liquidity, as would just U.S. rates are back down, the dollar's like back down. All of those things are liquidity positive, and at the end of the day, Bitcoin to me is just the most high frequency like liquidity indicator you can get. So I think there's a decent chance it starts moving back higher soon.
Well, it's interesting because the pullback here into this $54,000 range was smack into the fib retracement zones of that January to March rally. And the way I look at it is that the bulls here need to legitimately break this out north of that 60,000, this descending trend line, and really mark a breakout even above 62,000 to really say that the bulls are back and that they're taking command of the trend again. I think what's my biggest concern is that if they continuously are failing to break it above that 58 to 60,000, this could become a flagging formation for a continuation pattern down. And so the bulls really have a short window to really punch some key levels on the upside to regain control of the trend. I think it's such an important pivot level. I wouldn't want to make the bold call that which way it's going, but every day that this thing doesn't clear that trend line and a break on the upside, the more likely it is, in my mind, to still have another shot on the downside to kind of sort out where that bottoming levels will become. Anyway, we'll see how it plays out. But let's talk about the big breakout, which is gold. And you were mentioning it just earlier. And in my mind here, this could be a legit breakout. Obviously, we haven't cleared previous highs, but this corrected sideways versus downwards, and that to me is always a bullish sign. What's your take on gold, and are you playing it on the upside?
Yes, but definitely playing on the upside. Pretty much all precious metals at this point, and the miners. Like what's been notable lately to me is the miners, because you think about for longer than I care to remember, we had a lot of times where like gold was doing well, and the miners just didn't care; they wouldn't move. But then you think, I mean, as soon as as recent as yesterday, you had a day where gold was barely up, and the miners had a very strong day. So it's kind of you're getting reversal there. You're getting you've had silver outperforming gold lately. You've had junior miners outperforming, like I'll call them the senior miners. You've like I like to watch like the junior silver versus GDX just as like a proxy for the kind of underlying heat within precious metals, and like that ratio has done well. So like there's a lot of signs this is going very well. And obviously if you're going to get rate cuts, nominal yields down, real yields down, all those things are great for gold. I think the ultimate thing really comes down to central bank buying. That's what's driven the last, I'll call it year of performance. We've had China step away the last 2 months and not buy anything, which was very concerning to me. But then in June, they did it again. They didn't buy anything. But then you had India step in and buy like a shocking amount for 1 month. So to see that happen, it makes me feel like the game theory behind that is like, if India's like, well, if you won't buy, we'll just go buy it all. And then if I'm China, I'm like, well, if they're just going to step in and buy when we try to get the price down by stepping away, like we may as well just get back in there and buy. So I could see a scenario where at least one of those two is buying, if not both. And if both are buying and nominal yields are falling, then you could get some significant moves higher. And we're kind of in earnings season for gold miners. And that's, I mean, they're going to have just phenomenal earnings this quarter. So
what I find fascinating is we're at basically multi-year highs on the GDX, and I find that nobody's talking about it. I know that
100%.
You are talking about it, but the thing is that it seems like it's under the radar, and for something to be making multi-year highs and no one noticing or talking about it is to me actually a very good sign. Yeah, and it's like when people start noticing, that could become a true tailwind for this thing. It's been a great run here, certainly a great breakout. There are
So
obviously some laggards, but
So speaking of, if you go to the monthly and just like go all the way out to like 2011, whenever obviously gold peaked and we started to move lower from there, and you just kind of draw the trend line, downtrend line from 2011, I mean, it makes for a pretty
yeah,
pretty interesting
like
setup.
at some point, this could be a really big mover. I mean, it wouldn't be a shocker if like a multi-year trend, like out to 2025, 26, that we could be at $60+ on this thing.
Yep.
It's certainly a compelling new breakout, and it's certainly worth watching. But what's interesting is the other precious metals. Like, okay, gold is at near all-time highs. We're a stone throw away from punching those previous highs. But you take a look at silver, also approaching at least the May high. But when you again put this on a weekly or monthly chart and you zoom right out, silver's been behaving incredibly well. I mean, we are basically at a decade high. And if this thing goes, I don't see how it doesn't give it a shot to go back to those 2011-12 levels on the upside. Are you also bullish on silver here?
Yeah, big time, and been even more bullish than gold. So I, like you said, like it's doing so well, and it just like the miners, like who's really talking about silver other than the gold bugs that have been talking about it every day since forever. Like if it's not Mag 7, no one's pretty much talking about anything. But you look at today, and it's now obviously Mag 7's destroyed everything on almost any look back, but just on a day like today, you're what is that? Like 6% outperformance silver to Mag 7.
Yeah.
So on a day like today, it makes a pretty big difference.
So the other two precious metals, let's talk about palladium and platinum. And what's interesting is that palladium has just been in a 3-year bear market. It looks like the China index. It's just been an awful downtrend, but really it stopped making lower lows all year. And a lot of technicians will start to speculate whether or not we're seeing an extended bottoming formation and accumulation cycle. Do you think that the bear market and bloodbath is over for palladium?
100% I do, and I'll explain why. First of all, I encourage people to go check out the. And I'm not. First of all, let me be clear. I'm not a big positioning guy. I find most of the time it's not that helpful, unless it's just like wild multi-year extremes. But if you look at like Palladium, it kind of is wild multi-year extremes. Like everyone's short Palladium. It's been just completely demolished. Unlike obviously gold and silver, which are in gold near the highs, and then you have Palladium, multi-year lows down. I don't know, still like 70% or something. But the reason for that was because everyone just assumed that electric vehicles were going to take over the world. We wouldn't need catalytic converters and ICE vehicles or hybrid vehicles anymore. So there's no point in Palladium. Problem is, like, consumers kind of prefer obviously ICE, but especially hybrids more than the auto manufacturers realized. You really can't find an auto manufacturer that does both, that hasn't had to go and like retract everything they said a couple years ago about their new strategy for battery EVs versus hybrids and combustion engines. Huge like reversals there. Like Mercedes was going to be an all EV company, and now there's like, oh, just kidding. We're not only is that not true, but we're going to be building combustion and hybrids well into the 2030s. They said they would be EV only by 2030. I think GM was going to completely dismantle their entire hybrid like lineup, and then they came back and like, just kidding. Turns out you guys really like hybrids. We're going to keep doing that. So with that, like, that news flow has already hit. Obviously, auto sales aren't good. They've stayed below 2019 levels in the U.S. this whole time. But as you start cutting rates and getting credit flowing again, like, that will allow people to go buy vehicles. And the recent trends suggest people are going to probably buy hybrids or combustion engines. And if they do that, the demand for Palladium is going to go way higher than every analyst had it in 2025. So I think the price can meaningfully re-rate higher. And there are some totally destroyed, mining companies in that space that will probably have some really nice runs.
I mean, that was a 75% wipeout in 3 years, and I mean, if this thing retraces half of what it lost,
Mm-hmm.
it could be a double, and
Yeah.
and that's for a commodity. That's a great return.
And anyone that does the future space, there are some spicy futures contracts. So like, if you were to capture a decent amount of that with one contract, you will have done very well.
Yeah, absolutely. The other one I wanted to talk about is platinum, and well, let's actually start off with a weekly chart as well. But nowhere near as devastating downside as palladium. But overall, it's been a 2+ year sideways trade range, and slowly. It looks like it's creeping off up after a little bit of a buy on dip here. Are you also bullish on platinum?
Yep, same thing for the same reason. Because they put it in the catalytic converters. It's just a shockingly rare metal, so it moves a lot whenever it has to move. Palladium's a little more exciting because it is so beaten up. But I mean, really, if you think about platinum, it is as well. It's much more rare than gold. That's why for a lot of history it trades at a premium to gold. But I mean, now here we have it at a just massive discount, which I'm sure at $1,000 it's not particularly profitable to mine it at this level. So I think it has plenty of tailwinds, and once it gets moving, I think it'll have a nice bull run.
Well, there are I follow a number of these platinum stocks like SBSW, like Stillwater, which have also just been beaten down. It's and so, are you particularly bullish on as well these miners? And do you have a palladium play that you are particularly looking at?
Yep, this one. It's my favorite, and largely because it has the most hair on it. If you go back, if you remember, man, it's been years now, but I pitched Peabody BTU on the show a few years ago, and it's kind of like that was worse because that would like look like it might actually go bankrupt. I would argue,
Yeah.
you can't really make that argument with Peabody, but or with SBSW, but Peabody was a 10 bagger for me. That was a nice move, and for a few other folks out on FinTwit. I see a similar setup where you could have a multi bagger out of Sibanye. It's not. I mean, they're a high cost producer. It's not particularly well run. It's South Africa can be a pretty tough jurisdiction. They probably have too many assets in too many places globally. They started playing around with lithium for some stupid reason, but all those reasons are typically why whenever to me the best trades in the world are when you have a commodity that goes straight down, then it goes sideways for a couple of years, and then it breaks out, and then you go find essentially the kind of dirtiest producer of that thing that has just been crushed. And I think Sibanye fits that well.
Yeah, it's interesting that my story of Peabody is a funny one. When the thing was trading at about $1.50, I went in there, had a super high implied. I went and sold a whole bunch of naked puts down at $1. And I'm thinking, if I get stuck owning this thing at $1, I'm going to think. So the thing back over here on its earnings breaks down to like 70 cents. And can you believe I fucking blew it out at loss? Instead of sticking with my conviction, I would have been like the most epic trade of all time for me. And I epic fail. We don't get them right. I'm glad it worked.
We all have those bad beats, but that is definitely a bad one. I remember when I pitched it to you guys, and y'all were both like, "This one, like, thought this might go bankrupt," and I'm like, "Well, it might, but that's also why it might go up a lot."
Exactly. But yeah, anyway, SBSW is definitely interesting, and it just hasn't gotten on people's radars yet. I mean, it looked like it was coming to life back in May, and then just in June, it just went for that double bottom retest. But we'll see if as precious metals wake up here, maybe this will finally start to get a little bit of love.
Yeah, it just needs a Palladium bull market, and it'll be fine.
There you go. That's what I like to hear. All right. I want to move on and just touch on crude oil here. And again, this is one of these markets where everyone stopped talking about it. And I mean, back when oil was ripping back at the start of the year, or when you think back to last summer, there was this extraordinary moves in oil, and these energy stocks were ripping, and everyone wanted to buy these things. And suddenly here we are, $82, which is you could call it the mid-range, but it's certainly on the upper mid-range of some of the trade ranges. And in my mind, nobody's interested. Do you think that this is a meaningful turnaround in the downtrend we had here in the second quarter, or is this just going to be trade range bound in your mind?
Yeah, I'm kind of more in the latter camp. So I feel like from 2020 to 2024, I had like a good feel for oil. I usually had a decent ability to understand where we were going in the next few months. And then to me, that kind of broke down for me whenever we had the big move lower in early June after OPEC decided they would add some barrels back. I kind of thought that move lower was going to be more real than it turned out to be. Now, obviously, part of the reason it went back up was OPEC went out of their way to say, "Oh, whoa, like, just kidding. Like, we don't have to do that." And that was a big part of it going higher. But just watching U.S. Supply and demand, especially, like, this hasn't been particularly inspiring to me. Obviously, China hasn't been inspiring either from an oil demand perspective. So to have like the two mammoths just not seeing all that much demand growth just kind of bothers me. And then as a nat gas trader, like, I have all the scars of not being able to trust the producers to chill out and stop producing whenever they're supposed to. So I view oil as largely kind of like fairly priced at the moment and probably stuck in a decently tight range. What I will say though, you go out in the out years like 2026 and you can get it under $70. that I'm comfortable with, and I feel good about as a long. Like, so the only thing I own oil wise,
Would you
other
put that
than
on with options, or you would just go in there with the futures
I,
and just
yeah, I'm almost always a Delta One guy. So for me, I have no problem just sitting in it. The better approach probably is to buy some calls on it, to be honest. But I like the offshore equities, and then I like 2026. Other than that, I just kind of not really doing a lot.
So let's just touch on that gas because it looked so bullish in May and June. It just had a basing. I'm particularly looking at the September contract here, but it was basing. It turned up. It got above its moving averages, breaking higher highs. Really started to go, and then just had its feet kicked out from underneath it, and we find ourselves literally trading back to multi-year lows all over again. How do you size up the nat gas markets here?
Yeah, it's really this one factor thing, and it's the overproduction. They went from about, so back when it looked great, you had dropped production down to like 98 billion cubic feet a day, and then now we're right back up to like 102, 103. So just you can't trust these people to like actually allow for a bull market to like really come in. Like they just run right back out and put rigs to work. It was nice to see like some curtailment and production there, and that is what like really lifted us. But what I will say though, if you look at inventories, if they're drawing versus last year and they're drawing versus the 5-year average, so like the fundamentals are solid. It's just people. I think investors really want to see some discipline from the producers before anyone gets particularly excited on this. Go ahead.
How do you think the contango plays out into the winter? Because I mean, I think what is it like $3.50 the winter gas is already trading at. Like that's going to be a pretty big contango roll up that's going to happen in the next little bit. But do you think that there's room for the entire strip to rise, or is it just going to be more or less more of the same going in for the rest of the year?
Yeah, I think the strip is probably going to come under pressure. I mean, I've been saying that summer is the new winter. Like you really want to play summer because of all the air conditioning demand. And if you look, say like the last 3 years, and then if you look at like the current year versus the 5-year average, you tend to see improvements versus the 5-year average in storage in the summer, and then it degrades in the winter. It used to always kind of be the other way around. You want to be long in the winter to get the big drawdowns, and then get away from it in the summer because that's when you build. And that's obviously still the case, like nominally in real time, but versus the 5-year average, it's like flip flopped the last year or two. So my concern would be like winter won't be cold enough, and you will have significant inventory builds, especially if they're going to keep production over 100. So I would worry that that kind of out in December and on the strip is going to come under that pressure. I think the better approach, unless you have conviction on a cold winter for some reason, is to kind of play it in the summer for like what we have seen as far as weather, as long as you get the producers to kind of play ball a little bit too. I think this is overcooked to the downside. Like I think we've fallen too far. I don't think 220 something is fair price for the improvements we've seen versus the 5-year average. But so I think we can move higher, but I do worry about the winter.
Would you play it with the nat gas futures contracts, or would you play this with some nat gas stocks?
I think either the equities or if you wanted to do futures, I don't think you should really do anything outside of like end of 2025, like December 25 contracts, something like that, which are not super liquid and easy to trade. But like being anywhere in 2024 doesn't really make sense to me anymore, because all you're doing is making a giant bet on a very cold winter, and that it may work out, and it may work out great, but at the moment it doesn't feel like a safe bet. No. Unless you see producers like go back to the 90s firmly because the prices come back down, but I kind of doubt it. What I was honestly hoping to see was that oil move down. If that would have sustained itself, I think you would have seen a nice bull market in nat gas. I think that's really what you kind of need for nat gas, is to see oil take enough of a hit for enough people in the Permian to lay down rigs, because that would be a huge deal with all the associated production out there.
Right. That makes complete sense. Let's chat about copper. And copper back in March, April, and May went through an epic bull advance, and everyone, including Stanley Druckenmiller and others, were like, "Copper, buy, buy, buy! It's the story, it's the future." And really, that story quietly just went away, and everyone just stopped following it. It's been just a consolidation since then. What's your take on copper, and are you bullish here?
Not really. To me, copper has been like in 2024, it's largely been a China housing story. When everyone got fired up about a housing rebound in China, that's when it ripped. I mean, almost the correlation was pretty tight between housing stocks in China and copper. When everyone realized their stimulus wasn't really going to do anything, it kind of fell back down. And we just keep putting in new lower lows on the square feet under construction in China for housing, and that just makes it really tough on copper. You know, kind of coming out of the pandemic, you had a full 20% of global copper demand just for China housing. And now obviously we're spreading that out with all this offshore wind and electrifying everything. So like, you have a bunch of new sources. You have India stepping in a big way. So like, we are able to diversify that away from China housing, but China housing is still a huge impact. So while it's doing really bad, even knowing how uneven the production is, the supply and demand picture is over the next decade, like in the meantime, it's not good enough while they're not building enough housing in China. So I don't love it. I'm okay with owning miners here and just holding your nose and being like, whatever, like it's pretty obvious over the next decade it's going to work fine. But I think people that do that shouldn't have high expectations of their copper miners, in the immediate term. They should be fine with holding them long term though. And for that reason, being in the levered, futures part of it, just not for me right now.
So let's move on. I want to talk about uranium. I'm just going to put Sprott Physical on as the chart, but obviously there was an extraordinary bull market in uranium, and everyone was making money hand over fist throughout 2023 to the start of this year. But it's been a 6-month pause and correction here in uranium and the whole story. Now, some of these uranium equities, Cameco's a stone throw away from its 52-week high. The uranium ETF, like URA, is not that far from its high after a big pop here. But how do you size up the uranium markets here?
Yeah, I think we should be a lot higher. But at the same time, like, it was such a big move that it makes sense for it to have to digest here. As soon as we hit 100, like, it was pretty much game over for a few months. Like, enough people were going to take some off the table there. Even I did. I mean, I was long from 2016, and I promised myself the whole way, I was buying in the 20s, and I told myself, hey, we hit 100, like, I am taking some of this stuff off. Like, it wasn't much, but at some point you have to take some off. So I did. My guess is so did everyone else, and so that's kind of why we're here. But what's crazy is, since we peaked, the amount of good news for the nuclear industry and for the future of uranium demand has been just off the charts with the good news. And I mean, you've had legislation passed in the US, you've had regulatory reforms in the US, you've had new demand come from multiple countries, you've had restarts, you've had life extensions, you've had countries that haven't done this in decades talking about doing it again. Like, you name it, you've had the good news. And then obviously the production side, both the two biggest producers in the world just cannot really get production up. Like, everything you've ever could have asked for from news flow has happened, and the price is down. And that's, to me, that's the kind of things I like to step in and buy. What I will say though is, I used to not like to diversify out of the miners and out of the physical uranium into the industry. More and more, I like that. If you look at like NUKZ, the ETF that is kind of like in the industry. NLR, same thing, but like those have done great. Like, so you have some of these utilities that are like nuclear forward utilities. Obviously, that has had the AI spice added in, as well as people that are actually enriching the uranium and turning it into fuel. There's the whole supply chain is kind of captured in these, and that's done great. And I think that's a good place to be diversifying into for people that traditionally just want to buy uranium or the miners.
And what a great stock symbol, eh?
I know, right?
Indicates that it's easy to remember. The we I want to touch move on though. I want to touch on the eggs. And earlier this year, especially on that breakout
May
in the
they all
second
rest in
quarter,
peace.
yeah, I was all in on playing the upside of these, and that this was the big turn point in the ags, and just it looks like the nat gas charts, like it just
Hmm.
that was left for dead. Looked like it was the next bull market beginning, and wheat right back down to its lows, corn right back down to its lows, soybean right back down, breaking fresh new lows. It's the ag space just taking it on the chin. How do you size this up?
Yeah, you're not the only one that got sucked into some of this. I think I've taken 3 stabs at corn this year. All obviously have failed. I'm actually in wheat at the moment and cotton. Thankfully, not really. I'm kind of flat on them at the moment, but yeah, it's just been brutal. And I think there's been moments where weather looked like it was going to be atrocious, and you would have really significant problems with crops. And then you just get like stick saved at the end with the weather kind of comes through. Like we had it in Brazil where it looked like it was going to be way too hot and dry, and then you got some nice rains. In the U.S., I mean, even a couple weeks ago, it was looking like you could have corn pollination problems, and then a hurricane comes through and kind of cools it off. Like, so that's been a big part of the story. Just having weather come through right when it looked like you might have some issues. And I mean, at least as we're told, the crop sizes are pretty significant, globally. So I think it's oversold, pretty much all of it, but at the same time, it kind of makes sense. The one that has been nice lately has been coffee.
Yeah.
The KC version, like pretty nice here lately. We kind of kept hitting our head on the same level over and over and over, and you could just tell, like, once we broke through that, it was going to be on, and finally we did. So that is I think the only ag that has actually worked for me this year, which helped pay
It
for
is.
a lot of the pain and the other stuff.
There you go. But another one that's been beaten up is cotton in the same way that these other plays have been. Like it looked like such an extraordinary bull market in the first quarter of the year when it went from 80 to 100 and has given it back and more. And do you think that we're going to start seeing a bottom here at some point? Are you even considering it for cotton?
I am. I'm long at the moment. I would, I'll probably get stopped out, but the thinking. So the reason is down. The big reason I would say is like the Texas in the last few summers has been kind of the epicenter of the heat and the dry, and so far this summer it's been pretty good. Like they've had a lot of rain. They've compared to normal, and it hasn't been quite as hot. So you've had those like high pressure, just heat domes over the East Coast, West Coast, and Texas is like in the middle. Like this is fine. But my thinking was hurricanes between hitting Texas and then possibly Georgia could do some damage to the cotton crop, which could help. But so far, I mean, it's still early in hurricane season, but so far, like obviously we just had one and it was significant while in the Caribbean, but it, just not enough to do major damage at this point.
I wanted to touch on lumber as well. And lumber as well looked right at the start of the year like it was heading higher, hit up to 600. And it looks like the soybean chart, right? Like it got completely decimated to the downside. And it took actually a lot of the equities down. I'm just going to look here at Weyerhaeuser just for the sake of picking one. And you just had this monstrous drop in all of these. And interesting that with with that inflation number, it seems like whether home builders, lumber, and these forest stocks, product stocks, and stuff like that, all seem to have like upticked here. Do you think? Do you watch any of these? Is this on your radar on any of this stuff?
I do. So one of my favorite asset classes is timber, which probably shouldn't surprise anyone with the pine cone name, but uh, I I do think lumber getting smashed makes perfect sense. As far as the producers go, though, like you're kind of like below the cost of production, which doesn't happen very often for lumber. I would expect that to, uh, you know, curtail production and you have some problems. But lumber mills, they fought so hard to build up their staff after the big shortage. So, to start letting people go and to shut in production for them, like that's a big decision they'll have to make. But if they make it, obviously lumber can rebound. But I think it makes sense. I think housing and construction in the U.S. is in trouble. Like I do not think we have a housing shortage the way it seems like every other person on earth thinks. I think you're starting to see a pretty significant overhang in supply for new homes in the U.S. So you're actually at 2008 levels for new homes for sale. So I think cutting rates is actually going to lead to a lot of people listing existing homes, and that's where the shortage has been, is existing homes listed for sale. If that moves higher, there's way less need to go build new homes. So I think you could have a really significant overhang all of a sudden, and that's just going to hurt lumber. Not to mention, like a big source of demand for lumber is it's not like the big monster builders. It's like mom and pop people going and buying it at Home Depot to like do some stuff around the house, and everyone basically already did all that stuff like right around the pandemic, and now like that's like an area of elective spending everyone's choosing to just get away from. So probably not going to see anything good happen in lumber until you see lumber mills shut in production and let people go. I think housing will remain a headwind, but at the same time, some of the companies in the product sphere, even if you just look at the ETF wood, it doesn't look that bad. And if as long as Amazon needs cardboard and stuff, like a lot of these companies are going to be fine. So I honestly kind of like buying like the wood ETF, like getting all these different producers. Cut is the other one. I like buying it whenever it gets down to like the weekly moving averages and stuff, and that's kind of where we're at now. But I'm also happy to eat a drawdown and hold this for years and years. So it's not like it's a trade.
Right, right. All right. So I want to touch on Treasury bonds and then look at a couple individual stock names. I wanted to just start off with just looking at the 10-year yield because clearly with inflation numbers coming in a little bit lighter, it looks like we're heading to lower yields on that 10-year. And a lot of these bonds are ripping. Obviously, the 2-year bond significantly upticking, and even the long bonds are just crawling up to the top end of their ranges. There's a lot of people that are obviously in the camp that U.S. Treasury bonds are a bad long-term investment. But in light of the macro environment, do you think there's room for these bonds to have a good 2024?
Yeah, and it goes back to what I was just talking about. Like if construction rolls over enough to where they start letting construction jobs go, then that will probably create a feedback loop that leads to an employment problem, which will be enough to allow for a bull run in treasuries. I'm in that I don't really want these long term camp, but I don't see the problem with renting them short term. My preferred way to do that is actually self storage REITs, because they'll get the yield proxy as well as the like people having to get roommates or move or whatever and get a storage unit. I think it's almost like a double whammy, and it just feels like less duration risk to me. So that's how I'd rather do it. But I was caught off guard with the last 2 months of inflation. I thought they could move lower, but I was not expecting for
right
2-month annualized to be nothing on headline CPI. So, yeah, they're going to be able to do some rate cuts. I think that will actually hurt the economy. So as they do that, like there is definitely room for more of a rally. I would still buy the twos or 2026 SOFR or something instead of duration itself. But that's probably just a big bias on my end. Maybe not the best, maybe not right.
Right. So let's get to some individual names. We want to talk Intel, but before I put up the Intel chart, I wanted to first put it in the context of the semiconductor ETF because obviously Nvidias of the world have, with the market cap weightings, have just basically dominated, and you had these extraordinary rips in the semiconductors on the upside, but notably Intel was left behind in all of this, and obviously it's been an incredibly challenging. Let's say 2024 year where this has lost more than 30% of its value in that drop, 41% actually, and then it was left for dead. It looked like instead of a dead cat bounce, it just kind of splatted on the concrete on the downside and just stayed there. But you started to toy with buying this. What was on your mind, and what how do you trade Intel here?
Yeah. So the interesting thing to me was two things. One, they have a new AI chip that is rolling out in the third quarter, and it's supposed to be really good. Like it's supposed to be better than the outgoing NVIDIA chip. It can do more and use while using less power. So, but they are, they're one iteration behind because NVIDIA is about to come out with their Blackwell chips. So like it will definitely be behind that. But my thinking was like, not everyone out there that's going to do AI stuff is going to demand the hottest, best chip that's out there. There are going to be people like, that's cool. Like I just need to do some basic LLM stuff. I'll happily take the cheaper, Intel product. So my thought was they could really grow earnings on this new chip. And then I was reading about all this stuff, and you go look at the chart, and the chart is not at all suggesting that chip will matter. So to me, it just became a bet that the chip matters more than the market thinks. And then you looked, and you were in this tight coiling base, kind of from May to July, and I was like, well, I can buy it here with a really tight stop, and then if I get lucky, then we can break out to the upside, and maybe I have something here. So sure enough, we have broken out to the upside, but naturally we filled this gap and are getting pounded.
It's funny that happened exactly at the $30 level. It's almost like some big whale player basically had an open outstanding order to pick up anything and everything someone's trying to sell at 30, and just put the floor in on the stock. And one way or another, great call. Let's see whether it follows through for you. Is there any securities I forgot to talk about that you think we should mention?
I can't think of any off the top of my head.
We did do a lot, so but listen, a lot of amazing takeaways. I always love and getting your opinion on some of these things. There's so many interesting things that are going to happen here in the second half of the year. Maybe we'll wrap it up with do you have any bold calls on maybe how the market responds to the in towards the elections?
So going back to the duration side, it kind of makes it fun. I think you could have, to me, a red wave is looking super likely, and to me that is duration negative, because I think if either side had the control of all of DC, they would spin like crazy. So the Republicans are not going to be any sort of exception to that. I think they're going to probably, at the moment at least, it looks like they will take Congress and the White House, and I think they will spend a shocking amount of money. So the deficit will even expand from here. And if that's the case, I think you should probably, like equities, and you should probably not like bonds. Now, at the same time, if construction breaks and you're going to have a little recession and some rate cuts and everything, like obviously, sure, it makes sense to kind of go the other way for a little bit. Like maybe be careful with equity risk and own some duration. But I think, and people may wait for the election itself to really do anything, but I think that's going to be a problem for duration. And I think it just turns right back around and is a problem for small caps, even if they have a nice rally on rate cuts and stuff. So my fear is that the winners of the last couple of years will continue to win, because they'll benefit that much more from rates being kind of high and spending being really high.
No, let's. It's going to be definitely an amazingly interesting next 6 months. But Chase, I can't thank you enough for joining us here. Before I let you go, can you tell our listeners a little bit about what you do and where people can find you?
Yeah, so I wear a couple hats. I wear a research hat with Pinecone Macro Research, and then I work for the asset management firm Bulwark Capital, where I'm also the head of research. So really, it's kind of like one hat that just looks a little bit different. But yeah, if anyone's interested in either one of those, they can find them pineconemacro.com or Bulwark Capital Management, and that's mgmt.com. And always on Twitter at Pinecone Macro.
Well, Chase, thank you so much for joining us, bud, and have a great one. I look forward to having you back in the future.
Yeah, much appreciated. And I will be looking forward to it.
Now, before we close off the show, Kevin and I spent some time talking about Bob Farrell's 10 rules on investing. It dawned on me that it is great content for sizing up today's markets, so I created a video reviewing the 10 rules on my new YouTube channel at Patrick_Ceresna. We added the link to the video in the YouTube description of this episode and in the weekly email, so check it out. Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Give us a follow at The Market Huddle on X. And listen, you can never have too many friends. Bear market, bull market, we're just happy to spend some time together in this crazy ride. We'll see you all here in a few weeks. Cheers, everyone.